Welcome to Coffee with Joe for Thursday, October 21st, 2010. Joe, how's it going down there?
Pete, it's going great, Pete. Thanks, man.
We've been doing a lot of Coffee with Joes in the last few months on the monetary conference, on the program for monetary reform. We haven't really
Yep.
done one on the contemporary situation. What's going on in the news right now? What are our present day monetary authorities, the Federal Reserve, up to? What are their plans for righting this economy? They're not talking about the green shoots that much right now. And in
Yeah.
fact, let's see, Bernanke back in the spring was talking to Congress about winding down the quantitative easing program. QE1 was wound down in March, I believe. And the talk back then was, how do we pull this money back out of the economy when the economy turns around? Hasn't turned around yet, and in fact, they're not pulling money back out of the economy. They're putting more in the form of what some people are calling QE light. There's talk of a full-on second quantitative easing program being initiated, and it seems like the stock market is reacting positively to the fact that a major player is going to be buying capital assets in the near future. That would be the Fed. And they're doing it right now with their permanent open market operations
Right.
in
Right.
smaller amounts. So, Joe, do you understand what the plan is, and how do
Well,
we evaluate whether it's working or not?
boy, Pete, what's the plan? How to evaluate whether it's working? These are the kind of things that, I would say, like in an ordinary functioning national economy where the government, is basically, performing its role in terms of, ensuring that the national economy, is capable of working. We would know all that stuff. That is to say, for instance, when the monetary authorities in Japan originally did their quantitative easing, started their types of quantitative easing, Pete, they came out with the plan. They said, we're going to increase it this much. We see the effects are going to be this level of this and this level of that and this level of that, of employment, of inflation, etc. And then you get to see what happened, Pete. You get to see what happened and what didn't happen, and then you kind of get to score, if you will, QE as monetary policy, Pete. Okay, so instead of that, what we have is the guy who demands secrecy. I say secrecy, because we're not talking about what's going on with Fed monetary policy, Pete. Okay, goes into Congress and tells them, "Yeah, we're worried about inflation now that we've done all this stuff, Pete, and that's why we have to figure out. We've got all these excess reserves in the system, and that's all they can do, Pete. Once they get down to a zero interest rate policy, and we've had that for quite a while now, Pete. Okay, and 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 what has that done to bring the economy
Hasn't
back?
stimulated lending. That's what it's supposed to do,
Exactly.
and it's supposed to increase the money supply with the new lending that occurs, right?
Exactly. Right. I mean, that's the fallacy of Obama, comprehending how money works, to say, oh, yeah, but if we give $1 billion to the banks, they can turn that into $10 billion of economic activity. Yeah, if you could push on a string, But more important is the question about monetary policy and what do we know about it? What do we understand about it? What can we understand about it? And where is it going? So now, like you just said, we've got quantitative monetary easing part due for the United States of America is going to be coming. What form it's going to take, we don't really know. Certainly we have not fixed any of the problems with the toxic assets, Pete. Okay, so banks, investment banks, and therefore their relationships with the commercial banks remain at risk. Okay, Pete. We haven't solved any of that problem, and that's only the side problem to those of us who are people, who work. Our part of the economy is getting nothing out of it. But that part of the economy is still greatly at risk. And the problem of them being greatly at risk is what they're going to call the double dip, which is really just the second phase of the real dip. Okay, Pete? But the thing is that now we have Bernanke going around saying that we can have, another round of easing. What form it's going to take, we're not sure. We know that they're actually using the payments that they're receiving on some of the assets that they've already acquired to actually buy, to basically rebuy, additional government securities and stuff. So really, Pete, what it comes down to is we don't have a monetary policy, Pete. We don't really have one, or we have only one that's broken and not working, Pete, not capable of working, if you know what I mean. Quantitative easing, what does it do? All it really does is it acts on the banking sector to push up reserves, excess reserves. And I think we've got a trillion two of excess reserves now. So how many more excess reserves can we add before we realize that excess reserves mean nothing to the national economy?
Joe, could you just for a minute describe briefly what quantitative easing is for those who don't understand it?
Well, it can take many forms, Pete, okay? It just means that the Federal Reserve, using its money creation powers as the central bank in this case, okay, as the central bank in this case, either takes new issues of buying government securities, okay, or it could buy other things. And in fact, it has bought other things,
It's
including
mostly bought those toxic mortgage-backed securities, right?
Exactly.
From
It could be
AIG
that.
and
Yes, exactly. So, but the point is that it's newly created money. Okay, but when it's newly created money, it creates another debt into the economy that has to be paid back at some point in time. So the economy is functioning that it can't afford to make its debt service payments on its debt that already exists. And instead of throwing them a lifeline, they throw them an anchor. Here's more debt. So that you can. And what's it going to do, Pete? Where's it targeted? How is it going to do anything about the fact that we don't have employment and we don't have jobs and we don't have wages? So what we really need to do is, instead of Obama thinking, well, we could create $1 trillion of reserves and therefore create $10 trillion of loans and therefore economic activity. Instead of doing that, what he really needs to do is to understand that the government has the authority to create the nation's money supply, doesn't need to do it by going through the banking system, can do it directly itself, can pay that money into existence through programs that go directly to consumers so that we create the aggregate demand, which is really, Pete, what keeps the economy going. And Pete, if you could think about the fact that, to contrast, this situation that we have here now, the situation of the lack of monetary policy with the monetary policy, the monetary structure that Professor Yamaguchi has taken and incorporated into his model, which shows that, in fact, we can have, I don't want to say robust, economic growth, but we can have GDP potential, economic growth, aggregate demand, fully available. And we could have wages, and we could have it without inflation and deflation, Pete. If you think about that, and the fact that that's the monetary policy discussion that we really ought to be having, Pete, okay? And the fault, to a large degree, lies with the Congress and the administration, because the real politicians among them, as opposed to the kind of the moneyed, the people that are representing the banks and the moneyed interests, the politicians just don't have a clue about monetary policy and monetary systems and how things work. And if we could get them onto the track of understanding that there's no good to push the money down into the pipeline, Pete, the money has to go directly to the consumers and producers and consumers, Pete, that's what gets the engine going. And there's a way for the government to do that to the tune of whatever we need. It's like the tragedy of the commons is to not understand that we have a common here. The common is the monetary system, Pete. Okay, that's ours. It's ours to use. If the government knew how to use the monetary authority that it has, we would be on our way back into wages, back into the economy growing, back into demand growing, back into employment growing, and all of those things that really matter, Pete. So, we've lost that thread because there's no discussion of monetary policy, Pete. There's none. It just does not happen.
Joe, this might be a place to bring in the Thomas Edison quote that I don't think we've read on a coffee with Joe, but I've got it right here, and we'll finish off with that today. If the nation can issue a dollar bond, it can issue a dollar bill. The element that makes the bond good makes the bill good also. The difference between the bond and the bill is that the bond lets the money broker collect twice the amount of the bond, whereas the currency, the honest sort provided by the Constitution, pays nobody but those who contribute in some useful way. It is absurd to say our country can issue bonds but cannot issue currency. Both are promises to pay, but one fattens the usurer and the other helps the people. On that note, Joe,
What else is there to say?
we'll come back at it next week.
Okay, Pete. Thanks, brother.
Thanks, Joe.